Welcome back to the Brewing Trades Podcast. This is episode 6, and today we're diving into two critical topics for traders. First up, we'll explore correlations in Forex and futures trading. Understanding how different assets interact can provide a huge edge in your trading strategy. Whether it's oil influencing the Canadian dollar or gold's relationship with the Australian dollar, correlations are everywhere, and we're here to break them down. Next, we'll take a closer look at this week's economic calendar for November 18th through 22nd. With inflation data, PMI releases, and central bank speeches, it's a busy week filled with market-moving events. We'll highlight the key events to watch and how they might impact Forex pairs and futures markets. Grab your coffee, get comfortable, and let's dive into the world of trading.
All right, glad to have you back. You ready for another deep dive with us?
Always.
Awesome. So today we're going to tackle something that can be a bit of a head scratcher. Correlations in trading.
Yeah, this can be tricky.
But they're super important to understand, especially when you're dealing with futures and Forex.
Absolutely, because basically everything's connected, right?
Exactly. It's kind of like, have you ever noticed how sometimes you and a friend will show up wearing the same outfit without even planning it?
Yeah, it happens.
That's kind of like a positive correlation in the market. Things moving together. Or think about two people who always disagree on what movie to watch.
Total opposites.
That's kind of like a negative correlation. They're moving in opposite directions.
Yep.
And we're going to break it all down today. We're using a guide called Correlations in Futures and Forex Markets as our roadmap.
Sounds good.
So by the end of this, you'll be able to spot these connections, understand why they matter, and most importantly, know how to use them to your advantage.
That's the goal.
Right. So first things first, let's get a clear definition. What is correlation in trading?
Basically, correlation measures how closely the prices of, let's say, two or more assets move together.
Okay.
And we use a scale from -1 to +1 to represent this relationship.
Okay, so a scale. Got it.
So a perfect positive correlation, which is a +1, means that those assets move in lockstep. So if one goes up, the other one goes up, and the same if they go down.
Like a perfectly choreographed dance routine.
Exactly. But then on the flip side, a perfect negative correlation, a -1, means the assets move in completely opposite directions.
So when one goes up, the other goes down.
Exactly. Think of a seesaw.
Makes sense.
One side goes up, the other side has to go down.
Right. So we've got our two extremes, but what about everything in between?
Yeah, that's where things get really interesting because most correlations out in the real world, they're not going to be perfect +1 or -1. They're going to fall somewhere in between. So you might have two assets with, say, a correlation of +0.7.
Okay, so still pretty connected.
Yeah, generally they move in the same direction, but not always with the same intensity.
So it's like friends who generally have the same taste in clothes, but don't always wear matching outfits.
Exactly.
Now, I know these correlations, they're not just random. What are some of the big things that shape these relationships in the market?
Well, macroeconomic data is definitely a huge factor. Economic indicators like interest rates, GDP growth, inflation.
Right, the big picture stuff.
Yeah, all those things, they really influence how currencies and those futures contracts are going to behave.
Especially those tied to a specific country's economy, right?
Exactly.
So if a country's economy is booming, you might see their currency and, say, futures contracts tied to their stock market all rising together.
Right. It's like a rising tide that lifts all boats. Yeah.
Makes sense. So that's macroeconomic data. What else?
Commodity dependence is another one that's really crucial. Think about countries that rely heavily on exporting certain commodities, like Canada with oil or Australia with metals.
Right, like we talked about earlier, oil and the Canadian dollar. So if oil prices jump up, that should be good for the Canadian economy and their currency.
Yeah, pretty much. The Canadian dollar is often called a commodity currency just because its value is so closely tied to those commodity prices.
Interesting. So we've got the overall economic picture and the role of commodities.
Yeah.
Anything else? What about just the overall mood of the market?
Yeah, market sentiment. That's huge too. Basically, how are investors feeling overall? If there's a lot of fear and uncertainty out there, you might see investors flocking to what they call safe haven assets like gold.
Oh yeah, those safe bets. Like when everyone suddenly wants to wear the same safe outfit to a party.
Exactly. But that can be tricky too, because if everybody rushes to buy those safe assets, guess what happens? The price goes up.
Yeah, making them not so safe anymore.
Exactly. It's always a balancing act.
Okay, so we've got the big economic data, we've got commodities, we've got how everyone's feeling about things. Anything else?
Well, we can't forget about interest rates.
Ah, yes. Those always seem to be a factor.
For sure. Changes in interest rates can have a huge impact, especially on currencies. Think about it like this. If the U.S. Federal Reserve decides to raise interest rates,
The U.S. dollar usually gets stronger, right?
yeah, exactly.
Yeah.
Because investors are always looking for better returns, so they might move their money to where those rates are higher.
Makes sense.
And then that, of course, can impact the relative value of other currencies too.
It's all connected.
Yeah, and it's not just currencies. Interest rate changes, they can also indirectly impact commodity futures.
Oh, how so?
Well, a strong U.S. dollar can make commodities that are priced in dollars more expensive for buyers using other currencies.
Oh, so less demand.
Potentially, yeah. So lots of moving parts.
That's like a giant web.
Ooh.
Okay, so those are some of the big players that influence these correlations. Now, I'm curious to see how this all plays out in specific markets. Let's start with futures. What are some of the key correlations we see there?
Well, a classic example is the relationship between crude oil and the Canadian dollar. We touched on that a bit earlier.
Right, with Canada being such a big oil exporter.
Exactly. So when those oil prices go up, you'll often see the Canadian dollar appreciating as well.
So if you're a trader and you think oil prices are going to rise, you might consider buying some Canadian dollars or going short on the USD SAD pair, right?
Yep. You're basically betting that that correlation will keep going strong.
Makes sense.
Oh.
Okay, so besides oil and the Canadian dollar, what else is going on in the futures market?
Well, gold is always interesting, especially its relationship with the US dollar. Gold's often seen as that safe haven asset, and it's priced in US dollars,
Okay.
which usually leads to this kind of inverse relationship between the two.
Ah, so if the dollar gets stronger, gold often weakens because it gets more expensive for people buying it with other currencies.
Exactly. It's like that seesaw effect we were talking about before.
Okay, got it. So that's oil and gold. What about other commodities? Like I know those agricultural commodities, they can be pretty sensitive to a lot of different factors.
Oh, yeah, for sure. Agricultural futures, things like corn, soybeans, wheat, they're really influenced by things like weather patterns. You get a severe drought, for example.
That's going to mess with crop yields.
Yeah, it can really reduce those yields. And then what happens? Prices go up.
Classic supply and demand.
Exactly.
So if you're a trader keeping a close eye on weather patterns, you see a potential drought coming, you might want to consider buying those corn futures, thinking the price will go up.
Right, exactly. And it's not just the immediate impact on that one specific crop either. Remember, all of these markets, they're interconnected. So a drought in one place can actually lead to increased demand for imports from somewhere else. And that can create this ripple effect across the whole market.
Like a chain reaction.
Exactly. And that's where understanding those connections can give you a real edge.
All right, so we've covered oil, gold, agricultural commodities. Any other key correlations we should keep in mind in the futures market?
Yeah, a lot of traders watch the relationship between stock market indexes like the S&P 500 and then bond futures.
Okay.
Those two often have a kind of inverse relationship, especially when things get volatile.
Ah, so when the stock market goes down, investors might get spooked and move their money into bonds, which are seen as safer.
Exactly. Classic flight to safety. And that pushes bond prices up and bond futures lower.
Okay, so those are some of the big correlations in the futures market. But now, what about Forex? Are there any standout relationships there that can help us make better trades?
Absolutely. In Forex, interest rates and just the overall perception of risk, those are major drivers of how different currency pairs move in relation to each other.
Right, so it's all about those relative values and what factors influence them.
Exactly. For example, let's take a look at the EUR-USD and the USD-JPY pairs. Those often move inversely to changes in U.S. interest rates. So if the Federal Reserve decides to raise interest rates, the U.S. dollar usually gets stronger.
Right, because those higher interest rates attract foreign investment.
Yeah, increases the demand. And as the U.S. dollar strengthens, it often weakens against other currencies like the euro and the Japanese yen.
So if you think U.S. interest rates are going up, you might consider shorting the EUR-USD or the USD-JPY pairs.
It's a common strategy, but of course, remember that there are always other factors that can influence those currency movements too.
Right, got to look at the big picture.
Yeah, it's not just about correlations.
Now, switching gears a bit, let's talk about those commodity currencies in Forex. We talked about oil and the Canadian dollar, but Are there other examples? Well, what about the Australian dollar? They produce a lot of gold, right?
Oh, got it. The Australian dollar often moves along with those gold prices. So when gold prices rally, the Australian dollar often appreciates too.
So if you're feeling bullish on gold, you might consider going long on the IUD-USD pair, thinking that the Aussie dollar is going to get stronger.
Yeah, a lot of people do that. But like any correlation, it can weaken or strengthen over time.
So you always got to keep watching those relationships.
Definitely. Now, besides those commodity currencies, what other types of correlations stand out in Forex? Well, the behavior of those safe haven currencies during times of high market volatility, that's always interesting. We mentioned gold, but currencies like the Japanese yen and the Swiss franc, they often appreciate when things get a little bit shaky.
Yeah, it's like everyone's looking for a safe place to park their money. But doesn't that influx of demand eventually drive up the price, making them less attractive?
Exactly. That's a great point. It's that constant push and pull in the market. As demand for those safe haven currencies goes up, their prices rise. Eventually, they might not seem so appealing to new buyers. It's all about balance.
Makes sense. So even with those safe havens, it's a constant dance between risk and reward.
That's the Forex market for you. Always evolving. Economic factors, political factors, investor sentiment, they all play a role in driving those currency movements.
I'm starting to really see how interconnected everything is. These fascinating relationships between different assets, they can be predictable sometimes, but then other times you get these surprises.
That's the fun part.
It is. So this interconnectedness, that's where things get even more interesting when we start looking at what they call cross-market correlations.
Yeah, you're talking about relationships that span both Forex and futures.
Exactly. It's like bridging the gap between these two seemingly separate worlds. So what are some examples of how this actually plays out?
Well, let's go back to gold. We talked about how it often has that inverse relationship with the US dollar. Forex traders, they often keep a close eye on those gold prices because they can give them clues about what the dollar might do.
So gold's not just a commodity. It's like a spy sending signals about the Forex market. I like it.
Exactly. So for example, if you see gold prices starting to rally, that could be a warning sign that the dollar might be about to weaken.
Interesting.
Forex traders, they might take note of that and start adjusting their positions accordingly. Maybe selling dollar-denominated currency pairs or something like that.
It's fascinating how these two markets, they're always talking to each other. It's like this secret language of price movements.
And the better you understand that language, the better you can read those signals.
Okay, this is all starting to click. We've got these fascinating relationships, sometimes predictable, sometimes surprising. They're all influencing each other. It's kind of like this giant, intricate dance floor with all these different couples moving around.
And the music can change at any time.
Exactly. Which brings me to my next question. How can we actually use these correlations to make better trades?
That's the big question, right? Well, there are a bunch of different ways to leverage these correlations. One common approach is hedging.
Yes, hedging. Using those opposing forces to our advantage. So can you give us a real-world example of how that works?
Okay, so let's say you're super bullish on the Australian dollar. You're thinking the Australian economy is going to do great, so you decide to go long on some Aussie dollars.
Okay.
But you're also a little worried about the potential impact of falling gold prices, given that connection between the Aussie and gold. So what could you do?
Well, since gold and the US dollar often move in opposite directions, could you hedge your Aussie position by buying some US dollars at the same time?
Exactly. You're creating a counterbalance there. So if those gold prices drop and drag the Aussie dollar down with them, your US dollar position, that might appreciate, offsetting at least some of those losses.
So that's kind of like an insurance policy. You're protecting yourself from some of that downside risk. I like it. But what about building a portfolio that's just more resilient overall? How do correlations play into that?
That's where diversification comes in. And understanding correlations can make your diversification strategy a lot more effective. The basic idea is you want to spread your risk out. Don't put all your eggs in one basket.
Classic advice.
Right. But you want to do it in a smart way, taking into account how those assets might move together.
So you're not just randomly picking things, you're strategically choosing assets that have low or even negative correlations with each other.
Exactly. Think of it this way. You're building a portfolio with stocks, bonds, and commodities. Well, you might look for stocks and bonds that have a low correlation because they often tend to move in opposite directions.
Okay.
Then maybe you add in a commodity like gold, which tends to have a low correlation with both stocks and bonds.
So if one sector of the market takes a hit, the others might hold up better, kind of cushioning your overall investments. It's like assembling a well-rounded team.
Yeah, that's a great analogy.
Love a good analogy.
Oh.
Okay, so we've got hedging, diversification. What else?
Now we're getting into a more advanced strategy. It's called pair trading. Remember those friends who always show up in matching outfits?
Of course.
Well, pair trading is kind of like that. It's about capitalizing on those temporary divergences in the prices of two assets that are usually highly correlated. You're betting that eventually they'll get back in sync.
So you're basically looking for those moments when those matching outfits suddenly become mismatched.
Exactly. Let's say, for example, you're looking at the USD CAD pair and crude oil prices. They typically move in the same direction because, again, Canada's a big oil exporter.
Right.
But now imagine oil prices suddenly jump up because of some geopolitical event. But the USD CAD pair, it doesn't react as strongly as you'd expect.
So there's a disconnect, even though they usually move together.
Exactly. A trader who's savvy might see this as an opportunity for pair trading. They could buy the USD CAD pair, betting that it's going to catch up to those rising oil prices. And at the same time, they could sell crude oil futures, betting that the oil price surge is a little overdone.
So you're basically betting on that correlation snapping back into place.
You got it. But of course, there's always a risk that it might not.
So you're saying pair trading isn't foolproof?
No, not at all. It's more advanced. It requires really careful risk management. And there's always a chance that correlation could just break down completely.
Gotcha. So we've covered hedging, diversification, pair trading. Are there any other ways we can use correlations to make smarter trading decisions?
Well, one of the most powerful ways is using them to confirm the overall sentiment of the market.
Right, like we were talking about before, looking at all the dancers on the dance floor, not just one couple, trying to get a sense of the overall vibe.
Exactly. So for example, let's say you see the S&P 500 rallying. At the same time, the US dollar is weakening against most other currencies. And then on top of that, gold prices are going up. What might that be telling you?
Sounds like people are feeling pretty confident. Stocks are up, the safe haven US dollar is down, and gold, another safe haven, is in demand. It's a risk-on environment, right?
Exactly. And recognizing this sentiment, it can be really valuable for your trading decisions. If you're thinking about making a risky trade, seeing all those correlations align might make you feel more confident.
Right.
But on the other hand, if you're more cautious and you see those correlations start to diverge, you might want to hold back a little bit. It's like having a team of analysts whispering in your ear about the market's mood.
Okay, this has been super insightful. We've gone from the basic idea of what correlations are to actually thinking about how to use them in our trading strategies. But before we wrap up this part of our deep dive, I think it's important to remember that these correlations, they're not foolproof.
Oh, absolutely. They can change. And relying solely on past relationships, that can be a big mistake. Economic changes, policy changes, geopolitical events, all kinds of things can disrupt those correlations.
So you can't just set it and forget it. You got to constantly be monitoring these relationships and adapting your strategies.
Yeah, always be paying attention. And don't forget about the impact of those black swan events.
Those completely unexpected things that nobody sees coming.
They can totally throw everything off.
So it's a reminder that markets are complex and unpredictable. We have to be humble and be ready to adapt.
For sure. Understanding correlations is a valuable tool, but it's just one piece of the puzzle. You got to combine it with other forms of analysis, manage your risk well, and always be a little bit cautious.
Great advice. Well, we've covered a lot of ground today. We've explored what correlations are, the forces that shape them, and even some of the key relationships in futures and Forex.
And how to start thinking about using those correlations to your advantage.
Right. But we're not done yet. There's still so much more to uncover. We're going to delve into even more specific examples and really get into the nuts and bolts of how to leverage correlations for better trading.
Yeah, the real nitty-gritty.
So join us next time as we continue this deep dive.
Looking forward to it.
Welcome back. I'm ready to see these correlations in action now. We've laid all the groundwork, so where should we start?
Let's dive into a specific example. Remember how we talked about crude oil prices and the Canadian dollar? That close connection?
Oh, yeah, absolutely. Canada's a big oil exporter, so their currency tends to move up when oil prices do.
Exactly. So imagine you're a Forex trader and you're watching oil prices climb higher and higher.
Okay.
Knowing how they're historically correlated, you might start thinking, hey, the Canadian dollar, that's probably going to appreciate against other currencies, especially the US dollar.
So you'd maybe buy some Canadian dollars or sell the USDC CAD pair.
Yeah.
betting that the correlation's going to hold up.
Exactly. You're leveraging that relationship to try to make a profit. Now, let's switch gears to gold for a minute. Remember, gold often moves inversely to the US dollar, kind of like a seesaw.
Right. One goes up, the other goes down.
Yeah.
But what could cause that to change?
Okay, so let's say you're watching the Forex market and you see the US dollar index going up.
Right.
Based on the historical correlation, you'd probably expect gold prices to go down. But what if they don't? What if gold prices stay steady or even go up, even though the dollar is getting stronger?
That would be a sign that something else is going on, right?
Exactly. It might mean that there's a surge in demand for gold, maybe because of some kind of geopolitical uncertainty. So even though correlations can be really helpful indicators, you always have to consider other factors that might be influencing the market.
Right. Look at the whole picture. Okay, that makes sense. Now, what about those agricultural commodities? We talked about how things like corn and soybeans, they're super sensitive to weather.
Absolutely. A big drought, especially in a major corn-producing region, that can send those futures prices way up.
Yeah, for sure.
So let's say you're an agricultural commodities trader and you're really into monitoring weather patterns.
Yeah.
You see this major heat wave developing in the U.S. Midwest.
Okay.
It's threatening the corn crop. What do?
Well, knowing that corn prices usually go up when the weather's bad, you'd probably buy some corn futures, right? Thinking the price is going to go up.
Exactly. Reduce supply because of that heat wave, that's probably going to lead to higher prices.
Makes sense. It's all about supply and demand. These examples are really helpful to see how these correlations actually play out in the market.
Definitely. Now let's look at some more examples, this time from the Forex market. What are you curious about?
I'm really interested in those safe haven currencies, like how they react when things get uncertain. They seem to play a unique role.
They do. Think about the Japanese yen, for example. It tends to appreciate during those periods of global risk aversion.
Right, like when investors get nervous and want to move their money to a safer place. But how can you predict when those storms are coming?
Well, imagine you're a Forex trader keeping an eye on global events. You start to see geopolitical tensions escalating or maybe a major stock market sell-off happening.
Okay.
What do you think will happen to the yen?
Well, based on what we know about those correlations, I guess there'd be a surge in demand for the yen as investors look for safety. That would probably make pairs like USDJPY or URJPY go down as the yen gets stronger.
Exactly. Recognizing those correlations can really help you anticipate those shifts in the market. Now, let's look at another interesting correlation in Forex. The relationship between those commodity currencies and the prices of the commodities they're tied to. We talked about the Australian dollar and gold, but what about another example?
What about the Canadian dollar and crude oil? We discussed that one before.
Right, but think about it from a different angle this time. If oil prices go way up, that's good for the Canadian economy, right?
Yeah.
And that could actually lead to higher interest rates as the Bank of Canada tries to keep inflation under control.
Ah, okay. So higher interest rates would attract foreign investment, making the Canadian dollar even stronger. So a Forex trader could go long on the Canadian dollar or short the USD CAD pair, thinking the Canadian dollar is going to go up.
Exactly. Another good example of how understanding those commodity correlations can give you an edge.
Makes sense. Now let's get into those cross-market correlations, the connections between Forex and futures. That's where things get really interesting.
For sure. Remember that inverse relationship between gold and the US dollar that we talked about? A lot of Forex traders pay attention to gold prices because they can give them clues about what the dollar might do next.
It's like gold is sending secret messages across different markets.
Exactly. So for instance, if gold prices start going up a lot, it could mean that the US dollar is going to weaken. What would a Forex trader do with that information?
They might start selling dollar-denominated currency pairs.
Right.
Or buying currencies that they think will get stronger against the dollar. It's like using gold as a predictor for the dollar.
Exactly. Now think about equity indexes and Forex pairs. Remember how we said that if the S&P 500 goes down, it can trigger a flight to safe haven currencies like the Japanese yen?
Right. So when the stock market's doing badly, it can spill over into the Forex market.
A Forex trader who's paying attention to those stock market moves, they might see that yen rally coming and position themselves to take advantage of it.
It's amazing how these correlations can provide insights across different types of assets. It's like understanding these secret connections that link different parts of the financial world.
Definitely. And it's not just about predicting specific price movements. Understanding these correlations can help you make better decisions about hedging, diversification, and even finding arbitrage opportunities.
Okay, I'm definitely seeing the value of using correlation analysis in my trading, but I think it's important to remember that correlations aren't perfect, right? They're not always going to tell you exactly what's going to happen.
That's a crucial point. They can be incredibly valuable, but they're not foolproof. And those relationships, they can change over time. And sometimes something happens that nobody expected and it disrupts even the strongest correlations.
Right. Just because two assets have moved together in the past doesn't guarantee they'll always do that in the future.
Exactly. That's why it's so important to stay on top of things, monitor those correlations, and be ready to adapt your strategies.
So what are some of the things that can make those correlations shift?
Well, the economy is a big one. If a country's economy starts to struggle, that can have a huge impact on its currency and how it's correlated with other assets.
Right, like a recession in Canada could weaken the Canadian dollar's connection with oil prices.
Exactly. Policy changes are another big factor. Let's say a central bank suddenly raises interest rates. That can really shake things up in the currency markets and change those correlations.
I mean, what about those geopolitical events? Like, it seems like whenever there's a war or some kind of political upheaval, it throws everything off.
Definitely. Wars, trade disputes, political instability, all of those things can create shockwaves that disrupt those established correlations.
So traders need to be flexible, observant, and understand that the market is always changing.
Absolutely. It's a dynamic environment.
Okay, this has been a really eye-opening conversation. We've seen how correlations can give us insights into different types of assets, from oil and the Canadian dollar to those safe haven currencies like the Japanese yen. But how do we take all this knowledge and put it into practice in our own trading?
That's the big question. And that's what we're going to focus on in the next part of our deep dive. We'll talk about specific trading strategies that use correlations and how you can incorporate this powerful tool into your own trading.
Awesome. I'm excited to learn how to turn these ideas into actual trading strategies. Join us for the final part of our correlation exploration. All right, welcome back. It's time for the final part of our correlation exploration. We've talked about what correlations are, how to spot those key relationships in Forex and futures, and now the big question. How do we actually use this knowledge to make smarter trades?
It's all about recognizing both the opportunities and the risks that come with these connections between assets. Remember, we talked about those assets that are inversely correlated, the ones that move in opposite directions.
Yeah, like those friends who always disagree about which movie to watch.
Exactly. That disagreement can actually be a really useful tool for traders.
You mean like hedging, using those opposite movements to your advantage?
Exactly. Let's say, for instance, you're holding a big position in the Australian dollar. You're bullish on the Australian economy.
Okay.
But you're a little bit worried about what might happen if gold prices drop, because the Aussie dollar is often linked to gold. What could you do to protect yourself?
Well, we know that gold and the US dollar often have an inverse relationship. So could you hedge your Aussie position by also buying US dollars?
That's a great idea. By holding both of those positions at the same time, you're creating a kind of balance. So if gold prices go down and the Aussie dollar drops with it, your US dollar position might go up, which would help to offset some of those losses.
So it's like an insurance policy for your trades.
Exactly. You're trying to protect yourself from potential downsides. Now, what about building a portfolio that's just generally more resilient? How can we use correlations to do that?
Yeah. How does that work?
Well, that's where diversification comes in. And understanding those correlations can make your diversification strategy a lot smarter. It's all about spreading out your risk. The old saying, don't put all your eggs in one basket.
Right. But you're saying we can do that more strategically by looking at correlations?
Exactly. Instead of just picking random assets, you're choosing things that have low or even negative correlations. So let's say you're building a portfolio that includes stocks, bonds, and commodities. You might look for stocks and bonds that have a low correlation because they often tend to move in opposite directions.
Okay.
And then maybe you add in a commodity like gold, which usually has a low correlation with both stocks and bonds.
So if one part of the market isn't doing so well, the other parts might be okay. It helps protect your overall investments, right?
That's the idea. It's like building a team with a diverse set of skills. You want everyone to be able to contribute in different ways.
I like it. So we've talked about hedging and diversification. What other strategies can we use?
Okay, now we're getting into something a little more advanced. It's called pair trading. Remember those friends who always show up wearing matching outfits?
Of course.
Well, pair trading is kind of like that. You're looking for two assets that usually have a high correlation, and you're watching for those moments when their prices temporarily move apart. The idea is to bet that they'll eventually get back in sync.
So you're looking for the times when the matching outfits suddenly don't match anymore. But how do you actually find those opportunities?
It takes careful analysis and a good understanding of those historical correlations. Let's take the USD CAD pair and crude oil prices as an example. They usually move in the same direction because Canada is such a big oil exporter.
Right.
But now let's say that oil prices suddenly jump up because of some big geopolitical event. But the USD CAD pair, it doesn't move up as much as you'd expect.
So there's this temporary mismatch, even though they usually move together.
Exactly. And a trader might see that as an opportunity. They could buy the USD CAD pair, betting that it will eventually catch up to those higher oil prices. And at the same time, they might sell crude oil futures, betting that those oil prices are a bit too high and might come down a bit.
So you're betting that the correlation will get back to normal.
Right. But there's always a risk that it won't.
So pair trading can be tricky. You have to be really careful.
Absolutely. You need a solid risk management plan. Okay, so we've talked about hedging, diversification, and pair trading. Any other ways we can use these correlations to make smarter decisions?
What else?
One of the most powerful ways is to use correlations to confirm what the overall market sentiment is. Remember, we talked about looking at multiple correlations to try to get a sense of the overall market mood.
Right, like looking at the whole dance floor, not just one couple.
Exactly. So let's imagine you see the S&P 500 rallying, the US dollar getting weaker against most major currencies, and gold prices going up. What would you think is happening?
Sounds like people are feeling pretty optimistic, like it's a risk-on environment. Stocks are doing well, the safe haven US dollar is down, and gold, which is also considered a safe haven, is in demand.
Exactly. Recognizing that overall sentiment can be incredibly valuable when you're making trading decisions. If you're thinking about making a risky trade and you see all those correlations lining up, it might make you feel more confident.
Makes sense. But if you're more cautious and those correlations start to go in different directions, you might want to wait a bit.
Exactly. It's like having a bunch of market experts giving you their opinions on what's happening. Okay, so we've covered a lot of ground in this deep dive. We started with the basic idea of correlations, and now we've explored how to actually use them in our trading strategies.
It's been really insightful, but I think it's important to remember that correlations, they're not a crystal ball.
Oh, absolutely. They can change, and if you rely too much on past relationships, you could get into trouble. Economic conditions can change, policies can change. You could have some big geopolitical event. All of those things can disrupt those correlations and create new ones.
So we always need to be adaptable and watch for any signs that those relationships are changing.
For sure. And remember those black swan events, the unexpected things that nobody sees coming? They can completely change how the market behaves, making those historical correlations useless.
Right. Good reminder.
Understanding correlations is definitely a valuable skill, but it's just one piece of the puzzle. You need to combine it with other types of analysis, a good risk management plan, and a healthy dose of caution.
Great advice. Well, thanks for joining us for this deep dive into correlations. It's been a really fascinating journey.
It has.
Remember, always keep learning, stay curious, and never stop looking for those insights hidden within the financial markets.
Happy trading.
Thanks, Maya and Remus, for that detailed dive into correlations in Forex and futures trading. Now, before we move on to our second topic, I just want to take a moment to thank all of you, our amazing listeners, for tuning in each week. Your support keeps the Brewing Trades podcast running strong. If you're enjoying the show, don't forget to subscribe on Spotify, Apple Podcasts, YouTube, or wherever you get your podcasts. And hey, share it with your trading community. Let's grow together. Now, let's shift gears to this week's economic calendar for November 18th to the 22nd. Maya and Remus will guide you through the key market-moving events and how they might impact Forex pairs and futures markets. Let's get into it.
All right. Buckle up, everybody, because this week is going to be a wild ride. We're diving deep into the economic calendar for the week of November 19th.
Oh, yeah, it is absolutely packed.
And I mean,
potential market movers everywhere you look.
Really crucial week to be on top of things.
It is. This week is like a masterclass in global economics.
Okay.
Hitting all the major themes that have been driving markets.
Global economics.
Inflation, interest rate outlooks, global manufacturing, it's all connected.
How does that actually play out day to day, though?
Well, it's fascinating, actually. Each day has its own unique flavor almost.
Really?
Like chapters in the story of the global economy Tuesday, for instance.
Okay.
Kicks us off with central banks front and center. We've got the Bank of England, monetary policy report hearings.
So they're giving us like a sneak peek into their brain.
Yeah, but it's more than just data points. These hearings, it's a chance for them to actually talk to the market shape expectations, influence investor behavior, even the tone of the language. Can be just as impactful as the numbers themselves.
Like high-stakes poker?
Exactly. High-stakes poker, and they're holding their cards close.
Right.
But here's what's interesting. The Bank of England, they're focused on the UK.
Right.
But their decisions can ripple outward.
Yeah.
You think about it. If they raise interest rates, that impacts the British pound, which then could affect your travel plans if you're heading to the UK anytime soon.
So decisions across the pond can hit our wallets.
Absolutely. It goes beyond travel, too. Fluctuations in the pound can impact international companies.
I see.
You might be invested in, especially those doing business in the UK.
Global economics indeed.
Truly global.
Okay, so Tuesday, central bank intrigue. But wait, there's more.
Oh, there's always more.
Canada's inflation data also coming out.
Right. And this is important because the Bank of Canada has been pretty aggressive in raising rates to combat inflation.
Yeah.
So this data release the median CPI, trimmed CPI, common CPI.
A lot of CPI.
Could be a real turning point.
Potential Canadian dollar roller coaster.
Potentially. If inflation comes in higher than expected, it could fuel speculation of even further rate hikes.
Yeah.
Which could strengthen the Canadian dollar. On the flip side, if inflation is cooler than expected, might ease some pressure. Potentially weaken it a bit.
Got it. So watching central banks.
Yeah.
Keeping an eye on those currencies. Anything else for Tuesday?
Can't forget about the U.S.
Oh, right.
They'll be releasing building permits data.
Building permits?
Yeah. Might not sound as exciting as central banks.
Right.
But it's actually a sneak peek into future housing demand.
Okay, so how does housing demand fit into all of this?
Well, housing is a major driver of economic activity.
Okay.
It's linked to construction jobs, consumer spending, even overall confidence in the economy.
Okay.
So even though it might seem like a dry data point, building permits can actually tell us a lot about the health of the U.S. economy.
Interesting.
And remember, the U.S. economy has a massive impact on the rest of the world.
Like, these small data points are actually little windows into the big picture.
We're not just looking at numbers in isolation.
Yeah.
We're connecting the dots to see how everything fits together.
All right, so Tuesday, jam-packed with central bank news, inflation reports, housing data. What about Wednesday? Does it keep rolling?
It absolutely does. This time, the spotlight shifts to the European Central Bank, the ECB.
All right, let's dive into that. What's on their agenda?
Two big things to watch. First, their financial stability review.
Okay.
Gives us a sense of how they view the risks and vulnerabilities in the European financial system.
So they sound the alarm if they see trouble.
Exactly. And then later in the day, we'll be hearing from ECB President Christine Lagarde herself.
Okay.
Her speeches can really move markets.
How so?
She often drops hints about future policy decisions.
Oh, so traders will be hanging on her every word.
Absolutely. Looking for any clues about where the ECB might be headed with interest rates.
Got it.
And Lagarde, she's known for being quite cautious and data dependent. So while she might acknowledge the challenges facing the Eurozone, like the potential for recession, I wouldn't expect any major policy shifts just yet.
It's all about reading between the lines.
Exactly. The subtle shifts in language, the tone of her voice, those can be just as important as the actual policy announcements themselves.
Okay, so Wednesday, shaping up to be a big day for the euro. Potential for some serious market swings.
Definitely.
Depending on what Lagarde has to say.
Yeah.
Anything else on Wednesday?
Well, if you're interested in energy markets, the U.S. is releasing its crude oil inventories report.
Right.
And this one can often cause some pretty big price swings in oil.
Because it tells us how much oil is being stockpiled.
Exactly.
Which can affect global supply and demand.
Exactly. And right now, with oil prices already so volatile, due to geopolitical tensions and supply chain disruptions, this report takes on even greater significance.
I see.
Any unexpected change in inventories can ripple through the entire energy market.
Yeah.
Impacting not just oil prices, but also oil-heavy currencies. Okay.
Like the USD CAD and USDRU.
Okay, so we've got central bank drama inflation, watch housing insights.
It's a lot.
And now oil volatility. I'm starting to see why you said this week is a crash course.
And we're just getting started.
Oh, boy.
There's still so much to unpack, especially when it comes to global manufacturing and jobs data.
All right, definitely grabbing another coffee before we tackle the rest of this week. Let's take a break and then come back for part 2,
Sounds good.
where we'll dive into Thursday and Friday.
Looking forward to it.
Okay, we're back. Ready to tackle the second half of this crazy economic calendar week.
Buckle up.
Where are we headed next on our global economic journey?
Well, Thursday brings us a bit of a mixed bag.
Okay.
Some interesting data coming out of both Australia and the U.S.
Australia. I'm intrigued. What's happening down under?
It's true. They don't always make the headlines.
Yeah.
But the Reserve Bank of Australia, the RBA,
Yeah.
plays a key role in the global economy.
Right.
On Thursday, we'll be hearing from RBA Governor Bullock. Okay, so what kind of impact could his comments have? Should we be watching the Aussie dollar?
Absolutely. Even though this isn't technically a high-impact event, any unexpected comments from Governor Bullock could definitely send ripples through the Australian dollar, especially against the U.S. dollar.
I see.
Traders are always on the lookout for hints about future monetary policy.
Right.
So even a passing remark can sometimes trigger a market reaction.
Okay, duly noted. It's amazing how these seemingly minor events can have far-reaching consequences.
Yeah,
Really highlights how interconnected the global economy is.
it really is.
Now back to the U.S. What kind of data were we looking at for Thursday?
Well, for starters, we have the U.S. unemployment claims report,
Okay.
which gives us a weekly snapshot of the labor market.
Right.
It tells us how many people are filing for unemployment benefits.
Yeah.
So it gives us a sense of the overall health of the job market.
Right. So low claims generally point to a strong labor market,
Mm-hmm.
which can be supportive of the U.S. dollar. But we've been hearing a lot about a potential jobless recovery,
That's a great point.
where the economy might be growing, but without strong job creation.
Yeah, this week's unemployment claims report could give us some more insight into whether that trend is continuing.
Okay.
Be interesting to see if the numbers reflect a truly robust labor market
Yeah.
or if there are signs of underlying weakness.
Okay. So we're not just looking at the headline number.
Mhm.
We're digging deeper into the nuances
Excellent.
of the labor market.
Yeah.
What else is on the docket for Thursday?
We also have the Philly Fed Manufacturing Index coming out,
Okay.
which gives us a look at manufacturing activity in the Philadelphia region,
Right.
often seen as a bellwether for the broader manufacturing sector in the U.S.
So a strong Philly Fed index suggests that manufacturing is humming along,
Right,
which is good for the economy overall.
right.
But haven't there been some concerns about a potential slowdown in manufacturing?
Exactly.
Yeah.
There have been concerns about rising interest rates and slowing global growth,
Yeah.
impacting manufacturing activity. So this week's Philly Fed Index will be closely watched
Okay.
for any signs of confirmation, or conversely,
Yeah.
any signs that the sector is holding up better than expected.
Got it. So jobs data and manufacturing data.
Yeah.
Anything else for Thursday?
Yes. One more key data point.
Okay.
The U.S. existing home sales report.
Okay.
This gives us a look at the number of previously owned homes that were sold during the month.
Right. And as we discussed earlier, housing is tied to so many other aspects of the economy.
Absolutely.
So this report could give us further clues about consumer confidence,
Mhm.
economic growth, and even potential inflation pressures.
Yep.
But with mortgage rates still relatively high,
It's true.
I'm wondering if that's putting a damper on home sales.
That's a great question. It'll be interesting to see if existing home sales are holding up despite those higher mortgage rates,
Yeah.
or if we're starting to see a more pronounced slowdown in the housing market.
Okay, so Thursday is another busy day with those key data points on jobs, manufacturing, and housing, all giving us different pieces of the economic puzzle. What about Friday?
Ooh, Friday.
What's in store for us as we wrap up this economic roller coaster week?
Friday is going to be a data deluge.
Oh, boy.
Get ready for a flood of purchasing managers' indexes, or PMIs,
Okay.
from both Europe and the U.S.
All right.
PMIs are surveys of purchasing managers in various sectors of the economy,
Right.
and they're considered leading indicators of economic activity.
Leading indicators. I know we touched on this earlier, but can you remind us what that means?
Sure.
And why it's so important?
Of course. Leading indicators essentially give us a sneak peek into future economic trends.
Okay.
They tend to signal changes in the economy before those changes show up
Got it.
in other data like GDP or employment reports.
I see.
So PMIs are closely watched by traders and investors because they can provide valuable insights into where the economy might be headed.
Okay. That makes sense. So which countries are releasing PMIs on Friday? And what should we be watching out for?
We'll be getting PMIs from France, Germany, and the Eurozone overall, as well as from the US.
So a truly global perspective.
Exactly. And since these are all major economies,
Yeah.
these reports could have a significant impact on currency markets,
Okay.
especially the euro and the US dollar.
Right.
For example, strong PMI readings from France and Germany
Okay.
could boost confidence in the Eurozone economy,
Yeah.
potentially strengthening the euro.
But weak PMI data could raise concerns about a slowdown, which could weigh on the euro.
Exactly. And the same goes for the US.
Okay.
Strong PMI readings from the US could signal continued economic resilience,
Yeah.
potentially boosting the dollar, but weaker than expected PMIs
Right.
could raise concerns about a slowdown in the US economy, which could put downward pressure on the dollar.
Okay. So there's a lot at stake with these PMI releases.
There is.
It sounds like Friday's going to be a wild ride with PMIs coming out left and right.
It really is.
It's amazing how these surveys of purchasing managers
It's true.
can have such a big impact on global markets.
They provide a real-time snapshot of business sentiment and activity across various sectors.
Right.
And when you aggregate those perspectives from across the globe,
Yeah.
you get a pretty powerful picture of the global economic landscape.
All right. So we've covered Thursday and Friday, two very data-heavy days with key insights into the labor market, manufacturing, housing, and global business sentiment.
A lot to digest.
I'm ready for a recap.
Yep.
What are the key takeaways from this economic whirlwind of a week? All right, we covered some serious ground here. From the Bank of England's hints to Canada's inflation dance, U.S. housing whispers.
Don't forget oil's unpredictable swagger.
Oh, right. And then those PMIs that give us like a global pulse check.
It really is like a snapshot of the global economy right now.
Yeah.
This swirling mix of opportunities and challenges.
So if you had to pick one key takeaway for our listeners,
One key takeaway.
what would it be?
Volatility. This week is going to be full of curveballs.
I hear that.
Each data point has the potential to send markets zigzagging.
Yeah, it's a good reminder that even with all this deep analysis,
Right.
we can't predict the future with absolute certainty.
Exactly. We can analyze, we can spot trends.
Yeah.
But ultimately, the market has a mind of its own.
So true. So what are you personally most curious to see unfold this week?
Honestly, those European PMIs have really piqued my interest.
Really?
We've heard so much about a potential recession in the Eurozone,
Right.
and these PMIs could tell a very different story.
Interesting. So will they confirm those fears or will they reveal some unexpected resilience?
That's the question.
Yeah. Even in a week overflowing with data, there's always room for surprise.
Always.
Those aha moments
Absolutely.
that challenge what we think we know.
The markets are constantly evolving,
Yeah.
reflecting new information, new perspectives.
It's what keeps them so captivating, so dynamic.
It really is.
Well said. To our listeners, as you navigate this whirlwind week of economic news, stay informed, stay adaptable, and as always, happy investing.
And that wraps up episode 6 of the Brewing Trades podcast. Today, we covered the power of correlations in Forex and futures trading and dug into this week's high-impact economic events to help you stay ahead in the markets. We hope you found the insights valuable and can put them to work in your trading journey. If you enjoyed the episode, don't forget to subscribe on Spotify, Apple Podcasts, YouTube, or wherever you listen, and share the podcast with other traders in your network. Thanks again for tuning in, and as always, trade smart, stay informed, and keep brewing those trades. We'll see you next.